Alright, so the deadline to contribute to your RRSP for your 2019 tax return is March 2nd, 2020. So is it worth it? Is it worth contributing to your RRSP? What's the advantage? Where should you contribute? How much can you contribute? So in a given tax year return, your RRSP contribution limit is 18% of your earned income. So there's a difference, earned income of the previous year. So your 2019 RRSP contribution limit is 18% of your 2018 earned income. And that 18% cannot surpass 26,500, and that's for the 2019 year. But if you don't use your limits, you can use them in the future. So let's say in 2018 your earned income was 100,000, so that means in 2019 you could contribute 18% of 100,000, which is 18,000. But let's say you don't actually contribute in 2020. If your earned income in 2019 was also 100,000, then 18% of that is 18,000. So for your 2020 tax return, you can actually contribute 18 plus 18, so your limit is 36,000 because it's cumulative if you don't use it. So where can you find your deduction limit? You can find your deduction limit on your notice of assessment of the previous year, of course. So if you're going to prepare your 2019 tax return, you'll find your deduction limit on your 2018 notice of assessment. Now, the easiest way is actually to create an account online with the CRA. Just simply Google CRA My Account. If you don't already have an account, you'll have to sign up. And the first time, I believe they send you a code, security code, so that you can create your account first time. And then it's just a simple username and password to log in every time after that. So once you've created your account, simply go to My Account, Individuals, and then CRA Login. So once you're logged in on the home page, simply scroll down to where you see RSP and TFSA, and you can see here, it'll say your 2019 RSP deduction limit is, in my case, it's 11,000. That's the max that I can contribute for my 2019 tax return. If I don't contribute for my 2019 income tax return, this 11,000 will get added for next year. So two main reasons to contribute to your RSP. The biggest reason, in my opinion, is to get an income tax credit. So let's say you make $100,000 per year, and let's say you contribute $20,000 to your RSP. Well, then with that $20,000 that you've contributed, you've just reduced your $100,000 income by $20,000. So throughout the year, while you're getting your paycheck from your employer, taxes are being deducted from your paycheck as if you're making $100,000 per year. So you've already paid these taxes throughout the year. But then when you do your income tax return and you've actually contributed $20,000, you've actually reduced your $100,000 income by 20. So you should only be taxed on $80,000. So that means the taxes that you were deducted throughout the year by your employer was more than what you should have actually paid because you only earned $80,000. So that $20,000 RSP contribution will save you in taxes. So let's say you're in the, just for example purposes, you're in the 50% tax bracket. Well, instead of paying 50% on 100K, you're going to be paying 50% on 80K. So you're getting a tax credit of 50% of 20K. So for example, if you contribute 20,000 and you're making 100K, you should be expecting a tax refund of at least $10,000. It all depends on your tax bracket. If you're under 48,000, then you're basically saving 15% of taxes. That's just federally. Add on that provincially. So it all depends on which province you live in. If you're making over 214,000, you're saving 33% just from the federal side. Add on that your tax rate on the provincial side. So obviously it's better to contribute to your RSP when you're in a higher income tax bracket because your tax credit will be higher. Your savings will be higher. Does not mean you should not contribute to your RSP if you're in a lower tax bracket. But if you know, for example, that following year you're going to jump significantly in salary, then maybe it's worth waiting and get that higher credit the next year. If you know that your salary is gradually increasing year after year and it might take you 5 or 10 years to actually reach a completely different bracket, then it might be worth it to contribute to your RSP now because you're getting a tax credit right now. Money right now is worth more than money in the future. Obviously, it depends what you do with that money. If you spend it, that's a different story. But if you take that tax credit and invest it, then for sure it's going to be worth more in the future. Plus, because of inflation, $1,000 today can do way more than $1,000 in 10 years. Now, some people might say, if I contribute to my RSP, I can't touch that money. I can only use it in retirement. So that's really the second reason why RSPs are good, is to prepare for your retirement, to make sure that you've got enough savings for your retirement. But some people don't like really preparing for the future. They want their money next to them. They don't like having money that they can't touch. And they also say that what's the point of contributing to my RSP, get my tax credit, but then in the future when I withdraw my money, I'm going to pay that taxes anyways. Well, the idea behind RSP is that you're probably going to be in a lower income tax bracket in the future. But let's say you're not. Let's say you're going to always be in a high tax bracket. So let's say you contribute $20,000 to your RSP this year, you get a $10,000 tax credit. Let's say in 20 years you retire and then you start withdrawing money from your RSP. Even if you end up paying the same amount of taxes that you saved initially. So let's say you withdraw money and you end up paying $10,000 of taxes, the same amount that you received as a credit this year. $10,000 in 2019 or in 2020 is definitely worth more than $10,000 in 2040. Guaranteed you won't be paying the same amount of taxes because basic exemptions go up year after year with inflation. So on your tax return, there's a basic exemption that everyone is entitled to. So if you're making less than $12,000 or $13,000, that amount won't be taxed, but that amount goes up year after year. So in 20 years, that amount could be $15,000 or even $20,000. So if your first $20,000 is not taxable, while today your first $12,000 is not taxable, you're going to be paying less taxes in the future. So, and then there's other credits that come up and also increase. So even if by withdrawing your money in the future, you're going to be paying the same amount of taxes that you saved right now, it's still a benefit to contribute to your RSP because of time value and because of inflation. The value of your money is worth more now. Getting $10,000 now is worth more than paying $10,000 20 years later. And that's if you do pay $10,000 in the future. So in my opinion, I think it's definitely worth contributing to your RSP. I'm definitely going to contribute to my RSP to get a tax credit. I'd rather get a tax credit right now. Now, where should you contribute? Now, if you actually do a Google search on RSP, you're going to see a lot of bank ads. Scotiabank, Desjardins. Earlier this morning, I saw BMO and RBC. So you're going to see banks promoting RSPs right now. And on March 2nd, banks are going to be super busy. There's going to be a lineup. So RSPs, normally it's a long-term investment. It's money that you're not going to touch soon. You're allowed to withdraw at any time. You're going to get tax withheld on it though. So you sort of lose that benefit. If you contribute to your RSP now and withdraw it next year, you're going to end up paying back the same taxes if your income is the same. So if you truly plan on not touching that money, it is yours, but it's a long-term investment. It'll be yours to use in the future. Then the best place to contribute to your RSP is on the stock market. So banks will always promote their products. Of course, you could either contribute to a savings account. You could either contribute to GICs, which I think is completely useless because basically it locks up your money and it gives you an interest rate that's much lower than certain banks give you in just a savings account. A savings account, your money is not locked and you could get 2.5% per year, while GICs, your money is locked and you'll get like 1 or 1.5%. So there is really no advantage to GICs. So your capital is secure, and on most of them, so is your interest. But your money is locked for 1, 2, or 3 years, depending on the term that you take. And banks will definitely push mutual funds, which is an investment fund that's usually managed by the bank, which contains a group of stocks. But the problem with mutual funds is that it doesn't always perform well, and because of fees, it eats a big part of your profits. If you like mutual funds because you don't have to deal with your money, you don't have to manage your money, you don't have to pick the investments, if you're more of a passive investor, and if you trust the bank with your money, what would be even better than investing in mutual funds at the bank is simply buying the bank stock. If you trust the bank with your money, then you trust that the bank isn't going bankrupt, so why not invest in the stock itself? If you look at RBC, for example, if your plan is long term, let's look at 10 years or even 20 years. Let's look at 20 years. So let's look back at 2000. 2000, RBC stock was trading at $17. Today it's trading at around $108. So that's an average return of 26% per year. I think that beats a savings account or any mutual fund performance. That's over a 20-year period, and that's actually going through a stock market crash in 2009. If we look at a 5-year period, RBC was trading at 78. Now it's trading at 108. Just because the last 20 years were that good doesn't mean that the next 20 years is going to be like that. But in general, in the long run, stock market always goes up. If you look at the past 8 years, RBC performed at an average return of 7.6% per year. But not only that, you're getting dividends every year of about 4%, and that rate usually goes up. So you're getting an annual dividend of 4%. So that already beats the savings account or GIC. So you're getting an annual return of 4% in dividends plus any capital appreciation from the stock. Now let's look at TD, for example. 5 years from 54 to 75. Let's look at 20 years, 2000 from 18 to 75. So it didn't perform as well as RBC, but still a good performance. So in 20 years, TD performed an average 15% per year, plus it pays dividends of about 4 to 5% as well. So really, instead of just giving the bank your money and putting it in a savings account or a GIC that pays not even 2%, investing in mutual funds that usually have poor performance and high fees that eat up your profits, just invest in the stock, in the bank stock itself, especially if you're a long-term investor, which is usually what people do with RSPs. In fact, you could just buy an ETF if you want. You could buy the SPY ETF, which represents the top 500 stocks on the US market. You can invest in companies that you trust and love. Facebook, for example. Buy it, hold it, never sell. Guarantee that in 20 years you'll be making money. MasterCard, for example. MasterCard is a great stock. It has one of the craziest returns. In fact, let's look at the max here. So MasterCard went public in 2006. So let's look at it since 2006. It was trading at $4. Today it's trading at $340. So you would have made an average return of 600% if you had invested in MasterCard in 2006. So if you had invested $10,000 in 2006 in MasterCard, today in 2020, it would be worth $840,000. Now, that doesn't mean that the next 16 years of MasterCard is going to be the same thing, but this is just an example of how investing in quality companies you trust and love can, in the long run, generate much better returns than a savings account in the bank or a GIC or mutual funds. And if you even want to be safer, you don't want to be exposed to one particular stock, you could invest in an ETF that just represents the general market. The SPY, for example. If you look at 20 years on the SPY, in 2000, it was trading at 147. Today, it's trading at 337. So a 20-year return on the SPY, which is an ETF that represents the general market, top 500 stocks on the US market. So 337 divided by 144. So you would have made an average return of 6.7% in 20 years. In the last 20 years on the SPY, you would have made an average return of 6.7% per year. Plus, it pays a bit of dividends, pays about 1.75% dividend per year. Now, you can actually contribute to your RSP in 2019 and not use it as a deduction in the same year. So you could contribute to your RSP because you want to invest the money, carry forward the deduction to a future year where you think you're going to be making a higher salary in order to get a higher tax credit. But in general, just to give an estimate, if you contribute, let's say $10,000, depending on your bracket, of course, you can expect a tax credit of $4,000 to $5,000, but it depends on many other factors, but it's going to be in that range. So in my opinion, it's definitely worth it because I'd rather get money now and I'll just let future me worry about paying taxes in the future. There's always going to be a way to pay less taxes in the future. And even if I end up paying the exact same amount, money today is definitely worth more than that same amount of money in the future, especially 20 years later. So if you do want to contribute to your RSP and you actually want to invest on the stock market instead of just giving your money to the bank, putting it in a savings account, especially if you know it's money that you're not going to touch in a very long time and that you're investing for the long run, Questrade is great Canadian brokerage. Simply open an account, got a referral code below, use it to get up to $250 back. Interactive Brokers is also a great Canadian broker, but the interface is designed more for advanced traders, so it's not as user-friendly as Questrade. And of course, every bank has their own brokerage. You could open a self-directed investment account. Their commissions are higher than Questrade or Interactive Brokers. But if you really want to stay with your bank, so for example, with CIBC, if you want to invest in stocks yourself, buy your own stocks, manage your own money, you would open an Investor's Edge account with CIBC. So every bank has their own brokerage account. But really the easiest one to set up is Questrade. You could do everything online. You don't have to go anywhere. It's all electronic and they're cheaper than the banks. So remember, an RSP account is a registered account with the government, but you can open a savings account under the RSP account. You can open a GIC. You can open mutual funds. You could invest on the stock market yourself. So the RSP is just a box. It's a type of account, but you have many choices of investments you could choose from within that box, within that RSP account. Savings account, a GIC, mutual funds, individual stocks. So don't be limited to one thing. Really go with what matches your personality best. Even if you want something that's stress-free, something that's passive, you could just buy an ETF that represents the general market. You could buy one stock that you love so much and trust so much. You can buy the bank stock itself. You could buy a stock of an insurance company, Sun Life, 5 years from 39 to 66. Plus it pays 3.37% dividends per year. Remember, the RSP deadline is March 2nd. You don't have to wait till the last day. Some contributions you could do yourself online, especially if you've got your own brokerage account like Questrade. Tangerine has RSPs as well. You could open a savings account with Tangerine. Sometimes they pay up to 2.5% in their savings account. But even then, the only reason I'd go with a savings account is if you know that you're going to be withdrawing the money soon. You might need the money soon. It's not a long-term investment. But if it's a long-term investment, in my opinion, I think it's best to just invest in something really safe, something of high quality, like a McDonald's stock that never drops, or a MasterCard, and just hold it for 20 years. You can't go wrong. But the main advantage of contributing to your RSP is getting that tax credit right now, that income tax credit. So some banks will offer RSP loans. Is it worth it? So typically they have to be paid back in 1 year. So if you feel comfortable in being able to pay back the RSP loan in 1 year, and if you think that the interest rate that you'll be paying on the loan is less than the investment return that you'll be making with your RSP investment, in addition to that income tax credit that you're getting for contributing to your RSP, an RSP loan could be worth it. But really the main advantage of using that loan is so that you're able to contribute to your RSP in the current year, so you can get that tax credit sooner than later. But you're gonna also have to pay back that loan. So let's say you take a $20,000 loan, contribute to your RSP, you get a $10,000 credit. You take that $10,000 income tax credit, you pay back your loan, you still have $10,000 to pay on your loan, but you have a $20,000 investment in your RSP. And then you've got interest that you have to pay on that $10,000. So basically getting that loan allowed you to invest sooner. But if you didn't have that $20,000 in that given year, but you know that you'll be able to pay back that loan in the next year, so why not just save that money for the next year as if you were paying that loan? Just save that money, and then the following year you contribute to your RSP. You'll probably be in a higher tax bracket. You'll get a bigger credit. You won't have a loan to pay back, and you won't be paying interest. All right, so that's my opinion on the RSP. If you have any questions, leave them in the comment section below. And if you are interested in investing on the stock market and opening an account with Questrade, use my referral code in the description below the video to get up to $250 back. Thanks for watching.